Section 1. The Fire Chaser's Secret Weapon. Taming Options for Income. Booyah! You're on the path. Financial independence? Retire early. You're socking away cash. You're a saving machine. You're buying those beautiful, boring index funds. But you're hungry for more. You want to pour gasoline on that fire, don't you? You want another stream of income. A gusher of cash to accelerate your journey. Well, listen up. There's a tool that the pros use, a money-making machine for steady income. I'm talking about options, people. Now hold on, I know what you're thinking. Aren't options risky? You're not wrong, they can be, but you're not a gambler. You are an investor. I'll show you how to use options the right way, the safe way, to generate income. We're not swinging for the fences. No, that's a sucker's game. We'll use conservative strategies to skim a little extra, month after month. Think of it like renting out a room in your portfolio. Your stocks are the house, and you're collecting rent. Create a repeatable, methodical process that adds cash you can use to buy more income-producing assets. Section 2. Options 101. Your crash course in calls and puts. Don't let the fancy name intimidate you. An option is just a contract. It gives the owner the right, not the obligation, to transact at the strike price before expiration. Two key parts: a strike price and an expiration date. Two flavors: calls and puts. A call gives you the right to buy 100 shares. A put gives you the right to sell 100 shares. Buy calls when you think a stock could rise. Buy puts when you think it could fall. For every buyer, there's a seller. Here's the crucial part. You can buy options or sell, also called right options. Buyers pay premium and need a big move. Risk is limited to the premium paid. Sellers receive premium upfront. Cha-ching. But take on an obligation if exercised. Example: XYZ at $50. You could sell a $55 call expiring in 1 month for $100 premium. If XYZ stays under $55, it expires worthless. You keep the $100. If it's above $55, you sell at $55 and still keep the $100. A win-win. Or sell a $40 put on ABC for $80 to get paid to wait. If assigned at $40, your effective cost is $39.20 after premium. That's smart. Section 3. The twin pillars of options income. Covered calls and cash-secured puts. Now we're cooking. These are your bread and butter. Covered call. Own 100 shares you like long-term. Sell 1 call per 100 shares. Collect premium income. Your shares cover the call. A conservative, classic approach. If price goes above your strike, you sell for a profit and keep the premium. Drawback: you might miss some massive upside, but nobody went broke taking a profit. Cash secured put. Get paid to buy a great stock at a better price. Identify a high-quality name. Sell a put at a strike you'd happily pay. Secure with cash. No margin. Discipline is key. If price stays above strike, the option expires worthless and you keep the premium. If price dips, you buy shares at strike. Effective cost reduced by the premium. Either generate income or acquire a great asset at a discount. Strategic, not gambling. Options aren't a free lunch. There are risks. Understand them with eyes wide open. Learn time-tested strategies and stick to disciplined rules to put odds in your favor. Think like a business owner of your portfolio. Smart, calculated decisions. Ready to add a powerful tool to your financial arsenal? Good. Let's go. Spreads involve buying one option and selling another of the same type. Same expiration, different strikes. Why? To define your risk. Guardrails for your trading. When moderately bullish or neutral, consider a bull-put spread. Sell a put at a certain strike to collect premium. Simultaneously, buy a lower strike put as your insurance. This caps both max profit and, more importantly, max loss. ZIX at 105. Sell $100 put for $150. Buy $95 put for $50. Net credit $100. That's your max profit if above $100. If the stock craters, your long $95 put kicks in. Your max loss is strike difference minus net credit. Defined risk helps you sleep at night. Bear call spread is the opposite. Expect price to stay below a level. Spreads are more capital efficient and prevent any single trade from blowing up your account. It's the thinking person's way to trade options. This is the most important section. Read it twice. Read it 3 times. Great strategies fail without risk management. Rule number 1. Know your max loss. Before you click, know to the penny the most you could lose. Covered call risk is the stock to zero minus premium. Cash secured put risk is buying then stock to zero. Spread risk is defined up front. If you don't know max loss, you don't make the trade. Period. Rule number 2. Position sizing is king. Risk 1% to 2% per trade. On $100,000, that's $1,000 to $2,000 max risk. Discipline keeps you in the game through bad luck. Rule number 3, stay in your lane. Start with covered calls on blue chips, ETFs, cash-secured puts, and simple vertical spreads. Skip iron condors and butterflies until you have years of experience. Avoid buying FAR OTM weeklies. That's lottery ticket behavior. Rule number 4, don't use margin. Use cash you have. Cover calls with owned shares. Margin amplifies losses. For now, the answer is no. You're fired up. Hold your horses. Smart investors practice and paper trade first. Use your broker's paper account. Real data, fake money. It's your flight simulator. Learn order mechanics, test strategies, make rookie mistakes without financial pain. Treat it like real money. Paper trade 1 to 2 months and prove consistency. Go live with the smallest size. 1 covered call or 1 cash secured put on a low price ticker. Keep a trading journal. Stock, strategy, reason, entry, target, max loss, and results. Non-negotiable. Review weekly. Spot bad habits. Double down on what works. Remember taxes. Premiums are generally short-term, taxed like ordinary income. Track fees and choose a low-cost broker. Options aren't monsters. Used with discipline, they're an accelerator. Your index funds remain the engine. This is a business, not a casino. Aim for singles and doubles. Steady premium drips fill the bucket. Your plan. 1. Study covered calls and cash secured puts for 2 weeks each. 2. Paper trade 10-15 reps for a month. 3. Go live tiny on a stable stock or ETF. Build skill. Stay grounded. Stick to your rules. Keep your eye on fire. Booyah.